Module 1, this is the only question. So he gives you a bunch of random numbers that go on income statements and balance sheets, and he asks you to put them in order and sort of read and understand the income statement and balance sheet. So in order to do this, I have taken all of these numbers and copied and pasted them into Excel, and I've also done it removing the formatting. So here's how I would do this. I'm just going to start by cutting and pasting things that should be in the income statement into the income statement, and the rest of the stuff that should be on the balance sheet, I'm going to cut and paste into the balance sheet. I'm going to leave the years off for now because I don't really care about that in the moment. Okay, sales. That's obviously going to go on the income statement. What else? Cash is not going to go on the income statement. I'm going to cut it and paste it way down here under assets. And let's write income statement here. Okay, dividends. This was like kind of a trick to throw you off a little bit. Dividends are not included in the income statement or the balance sheet because they are paid out after you pay taxes. The idea is, or they are paid out separately. It's a separate expense, and it's not going to be included on the income statement. So we're just going to delete that. Inventory is going to go under assets. It's a current asset. Net fixed assets is a non-current asset. Accounts payable is a liability. And it is a short-term liability. Alright, cost of goods sold is going to be the second thing on the income statement. And what does he call this? He calls it gross profit. Let's add our little bottom border here. Okay, so what comes next on this? These are all going to go on the balance sheet. I'm going to move this up because accounts receivable is a current asset. The only way that I know that there's only 3 current assets is because I just did this to check and see if I did it right. But you could scroll up and see if there was something else. But basically accounts, cash, accounts receivable, and inventory, are going to be your current assets. Depreciation, other expenses, that's going to go under gross profit. This will give us EBITDA. Let's add a line here. To get rid of the DA, we're going to take out depreciation. This will leave us with EBIT. We have interest, which is tax deductible. So this will leave us with pre-tax profit. Okay, let's delete a few of these. This is 2018 and 2019, I believe. 2018 and 2019. Okay, and then we need taxes are 21%, so let's pay our taxes, 0.21. And this will be our after-tax profit. So our taxes are going to be that times that. Let me lock this cell. And let's just get rid of the last decimal places. We don't need those. Minus that. And add a border. Okay, so for our income statement, we did sales minus cost of goods sold, got the gross profit. We had some other expenses which gave us EBITDA when we subtracted them. We took out depreciation, we took out interest, we took out taxes. Our after-tax profit would be $2,400 and $2,600 respectively. So let's check that and make sure we did it right. $2,400 and $2,600, we did that right. Okay, let's move on to the balance sheet. Okay, so we have current assets and non-current assets. Those are the only assets that we have. Hold on. Total assets. Okay, and then now we have liabilities. Oh wait, I already did that. Let's delete this. Okay, so we don't have any other liabilities, just these three. Short-term notes payable is going to go into your short-term liability. We're going to have some long-term debt. We'll move this up. Total short-term liabilities equals that plus that. I'm going to add a bottom border. Long-term debt, the only thing that we're missing here is shareholders' equity. Total liabilities. So our total liabilities are going to be that, plus that, plus whatever equity is, but he didn't give us, he didn't give us equity, so we got to back into what that is. So let me just bold this so you can look at the difference. All right, total assets are $56,000. Total liabilities only add up to $20,000. So the difference is going to be 56 minus 20. Oh, it's a circular reference. I got it. Let's delete that and delete that and start over. Okay, we need this to add up to 56,000. So this is going to have to be 56,000. Let's set that equal to that. That means that our liability is going to be 56,000 minus this plus this. Does that give us the right number? Let me make sure. Oh, it does not. And the reason it doesn't is because this has to be a minus. All right, let's just check this and make sure everything's right. That plus that should equal 56. Yes. Oh, you're going to give me the error again. There we go. We got it to go away. And let's check it. This plus that equals 62. Okay, so let me explain this from start to finish. These are all the assumptions that he gave us. So we have short-term liabilities from accounts payable and short-term notes payable. We have long-term debt, and then we need some equity number that makes assets equal liabilities, which is something that you should have learned in your accounting class. To do that, we know total assets is 56,000. We picked a number, 36,800, that made total liabilities add up to 56,867. We did the same thing in the next year. So that's the way that you solve this. The question here, the next question, total debt at the end of each year. So total debt is going to be this long-term debt plus this short-term notes payable. And essentially what he means by total debt is just stuff that we owe interest on. So long-term notes payable, there's going to be some interest rate. Long-term debt, there's going to be some interest rate. Accounts payable is not included, and the reason for that is that there's usually no interest rate. It's just sort of like a bill that you have to pay. It's a place marker for bills that we need to pay in the future within a certain amount of time, like usually 6 months or a year, sometimes 30 days. So anyway, the point is long-term debt is only short-term notes payable and long-term debt. All right, non-interest-bearing liabilities at the end of each year. So the only non-interest-bearing liability should be your accounts payable. Let's make sure that I didn't forget anything. Yeah, only your accounts payable. And then the next question is total liabilities at the end of each year. Well, total liabilities are going to add up to, oh, I see, we're going to add the, so here we get 20,000 and 22,600. This is just long-term debt plus short-term liabilities. It's everything but equity. And then finally, working capital. So working capital is current assets minus non-debt current liabilities. And so for here, it's just going to be, these are our current assets minus, this is a debt item. So this is the only thing that we need to think about for working capital. And that's 14,995 and 18,450, which is what we have here. A good way to think about this intuition-wise is that this is our sort of cash accounts. Like, not all of it's cash. We have some accounts receivable. We're waiting to get paid on stuff. We have some inventory that we're going to sell soon. And then we also have some notes that we need to pay. So working capital is kind of the difference between the two of those. That's the way that I would think about it.